And welcome everybody. This is Kurt Frankenberg. I'm coming to you live from Monument, Colorado, where I'm looking outside and can't see the mountains because it's all covered in clouds and rain. So, and I'm joined by my good friend Mike Chupka on the East Coast, where the weather is probably better. How's it going?
Yeah, things are good here. It's a nice summery day. We're probably expecting rain in the next couple days, but right now it's a really nice day here out in the Mid-Atlantic.
Happy. Okay. Well, folks, I commend you for coming in the middle of the day to an options trading seminar. I know that many of you are brand new to radioactive trading, and probably some others are veterans. I'd like to kind of find out. I'm going to launch a little tester poll here real quick there, Mike, and just find out where folks are coming from. And while you're filling it out, I'd like to draw your attention to something. We have a lot of folks that ask us for the slides. After we do one of these classes, they say, hey, could I have the slides? And can't do that, and one of the reasons is that we've been battling international plagiarism for quite some time, particularly out of Singapore. But what we can do is offer you that, hey, if you're on our list, and that's how you got invited today, okay, if you're on our list, if you look in the upper right-hand corner, there's an icon that looks like a camera, and if ever you want to screen capture what you're seeing, just hit that icon and it'll save it to your desktop. Okay. All right. So, Mike, our population is changing. We're getting new people in the doors every moment. There goes another one. Another fellow just came in, or maybe it's a fellowette, maybe it's a lady. And our poll is also very quickly filling out. So I'm going to go ahead and close that poll. Not everybody got a chance to vote, but more than half you did. So let me go ahead and share that. So we've got a lot of folks that already own the blueprint. Look at that, 43%.
Okay.
So welcome back, guys, and thanks for coming in here. And of course, you can always pose live questions during these webinars, and of course at support@radioactivetrading.com you'll get an answer very quickly regarding any questions you have about any of the 11 income methods in the blueprint. Today we're going to be showing 2 income methods, number 5 and number 4, that we shared with one of our members a couple of years ago. Let's see, second place, thinking about getting the blueprint. Okay, so we got a lot of folks that already have it, but then we get in second place, we got folks that are thinking about getting the blueprint.
Mm-hmm.
And then we have 14% that this is their first class, and we have 14% that are repeat offenders. So you liked it enough to come back, and so thank you. We welcome you back into the fold here. And then 7% are Fusion members. Fusion members, I have a very exciting announcement coming up very soon. I can't give away details right now, but it's for you only. So, thanks for being a Fusion member. Okay, let me go ahead and hide that. And what we're going to be talking about today is bulletproofing. And we're going to use 2 income methods to take a stock into the bulletproof zone, okay? But we're going to also show a historical trade, and if we have time, we'll show off, Mike, we'll show off the PowerOptions tools for finding these kinds of trades in the first place, and also what you're doing to track them, and we can do that with one of your trades, okay? So, all right, here's my ugly mug. This is what radioactive trading is about. It's about providing the best options education available to help people stay out of trouble. I'm a martial art instructor. I have been since 1986. I own a martial arts studio here in Monument, about a stone's throw away from the coffee shop I'm sitting in. And one of the things that I found out early on as a fighter in the ring was that if I was to keep my hands up, if I would pay attention to defense first, then almost everything else was going to take care of itself. And the same thing applies in the market. If you're losing money, it's very hard to scrabble your way back to square one unless you really, really control those losses. And so radioactive trading was founded to help people stay out of trouble and raise awareness of the married put strategy, which combines position sizing, the most important thing in trading, with absolute stops, and still allows you to take out income. A lot of folks are still involved in this cover call trading and other types of options plays that aim to take premium out of the market. I'm going to throw up a little poll there and see what folks are already familiar with, and we're going to blow your socks off there, guys. At least that's my intent. That's what I'm hoping to do here. If you trade covered calls, I'm going to show you a turbocharged method that does quite a bit better. If you're taking it the other side of those covered calls, long calls and puts, I'll show you something that doesn't use leverage or where leverage can't be used against you. Kind of cool. And if you're a spread trader, you'll particularly enjoy today's class because we're going to do a very, oh gosh, it's often used by hedge fund traders and insider traders. It's used by folks that have a lot to lose. They have a lot to lose, but also are able to leverage their time for short-term gains. And it's a very risky play normally, but we're going to show how to do this play without risk. All right, I'm going to leave that up for another 3 seconds, 2 seconds, 1 second. If you haven't let us know where you're coming from, let us know now, and then shabam, there we go. Okay, Mike, our majority is spread traders today. Look at that. Happy day. And a tie for second place. I guess this makes sense. We got one side doing covered calls and the other side buying the long call. Or we got the other side, one side doing the naked puts, the other side is picking them up. So very good. Okay. Okay, I tried to unshare that. Is it still up, or is my little symbol up there?
I'm still seeing the poll results there, Kurt.
Still seeing the poll? Let me try it again. I'm trying to hide it. Okay.
It's hidden. There you go.
There we go. Okay, so today's webinar is not given with profit motive in mind. We do own books that we sell. We have the blueprint and the home study kit, and but today all we're going to be doing is sharing content, and here's what I intend to do. Okay, bulletproofing with the income method. 100% content guarantee. We're going to take a common problem for traders. We're going to fix that problem, and we're going to point you out to further free resources. And you know, if you want to pick up our premium resources, you know where to go. You know, it's radioactivetrade.com and the products tab. Okay, so here's what to expect. We've already done this introduction. We've already asked what kind of options plays folks are doing now. Here in a little while, I'll ask how well you're doing with that. But here are the bold promises. We're going to show you the solution to a big problem facing buy and holders today. It's going to make a lot of sense. In fact, I'm willing to bet that you'll take a look back and wish that you had been employing it earlier. I'm going to show you a riskless spread trade, which is done at a credit. And normally a credit spread involves risk, doesn't it, Mike?
Well, of course, yeah. Normally, when we're looking at a credit spread, Kurt, we're looking at you know, a good probability, a 75–80% probability that our spread would expire worthless. And of course, what ends up happening is to get that kind of combination, we're seeing a risk-reward ratio of maybe 9-to-1 or 10-to-1. So one loss could wipe out 10 previous trades.
Exactly. If you're doing a bull put spread, for example, and your stock stays up or goes up, you get to keep your 50 cents, you know, or whatever it was. But should it go against you, you're going to end up losing $5.
Mm-hmm.
$5 a contract, or you know, $500 offset by the $50 that you picked up. You know, so anyway, this particular spread trade done in the context that I show today is riskless, and this particular riskless spread trade can pay you twice. So it's kind of exciting. Finally, I'm going to show how it's possible to take income from your stock without necessarily selling it or necessarily limiting the upside. So are we ready there, Mike? Shall we dive in?
All right, Kurt, I think so.
Let's rock. Okay, we already did our baseline reading. Here's the problem. I said I was going to solve a problem that's common to traders, and this is a common problem. And guess what? If you don't have this problem, you want to have this problem. Your problem is your stock is up from where you bought in. Okay? All right. And now, if that's the case, what do we do now? You know, this is kind of a nagging question. It's just as stressful, I think, in a different way, but it's still stressful to have a stock that's up from where you bought in, or even an option play, you know, that's up from where you bought in, because now you're feeling like, well, geez, what do I do now? I don't want to feel like a chump. If I sell my stock and then it keeps going higher afterwards, I'm going to miss the boat. That's not fun, okay? By the way, that's a haiku. I wrote that. Are you dazzled with my brilliance? Here's another one. If I hold it, I might give back my profits. Stock goes down the drain. If and I've done this before, back before the days of radioactive trading. And I know that you can probably relate, but I bought into a stock, saw it go way high. I had bought in at $9.50, and by the time it was finished with its run, it was at $24 a share. And I thought I was a trading god. But then when it came down to $18 a share, I thought, well, I can't sell now. You know, it was at 24 before. Then we got to 12. I thought, well, you know, that's half the level. It's going to buoy back up. It'll get there. Then when it got to $9, I said, well, I can't sell now because that's less than where I bought in. I bought it in at $9.50. And so it went. And then finally, Mike, you know the end of the story. I ended up liquidating that stock for 26 cents a share before it hit the pink sheets. And that was just silliness. You've had a similar experience, I think, with DryShips, was it?
Yeah, and then DryShips, when the bulk shippers were in their craze, and then most of them are down about $5 a share now. Some of them were up over the $100 range back around 2006, 2007. I mean, what's more important today, I mean, I'm sorry, Kurt, not more important, but what we're, you know, think about just today itself. I mean, how many of our people in attendance today maybe tried tracking their stocks or their covered call positions using trailing stops, and they were trying to just move up the trailing stop, move up the trailing stop. You're probably out of half of your positions today. The market may recover tomorrow, may recover Monday or Tuesday, but you are sort of out of the positions now with the drop.
Yeah, and those drops, they can be catastrophic, or they can be just plain annoying. But either way, you know, you can feel silly for having held a stock thinking that it's, hey, it's going to keep being good, and then end up giving back your profits. Well, why hasn't the problem been solved yet? Here's the deal. We've only discussed two choices. We've discussed holding, and we've discussed selling. And there is another option, you know, not to make a pun, but here's the deal. Everybody's heard this little chestnut: cut your losers short and let your winners run. Okay? But the problem is, few give the practical instruction of how to accomplish it, how to cut your losers short and let your winners run. Well, first of all, I'm going to show you what that isn't, okay? And the folks that have been trading covered calls for a period of time, they understand this. Mike, is this chart here, the risk-reward graph, is that congruent with the saying, cut your losers short and let your winners run?
Well, no, Kurt, it's the exact opposite, isn't it? The structure of this trade cuts our winners short. It caps our upside if we pick the right stock, but it still allows our losers to run. And sure, you may have collected 2 to 3% in premium, but that still means you're on the hook for 97%, 98% of the stock ownership.
Right. And if we consider selling a put, you know, selling a put has pretty much the same risk-reward graph. It just doesn't involve owning the stock in the first place. But if your stock goes down, it follows this exact same curve. Okay, so folks that sell naked puts and folks that or cash secure puts, folks that sell covered calls, they experience this. When they're right, they make a little, and when they're wrong, they get hurt. Okay, so it's backwards of cutting your losers short, letting your winners run. What about spread trades, Mike? Do spread trades meet the criteria of cut your losers short and let your winners run by their very structure?
Well, it does cut your losers short. Here we're looking at a bear call spread curve. And we have a limited risk, meaning we know what the risk is going in. We can't lose more than the difference in strike prices minus the net credit. But if I had a bear call spread here, Kurt, by maybe selling a 50 call and buying a 55 on a stock that's, let's say, trading at $47, and we make 50 cents, well, if the stock stays at 47, both calls expire worthless, we keep the 50 cents. Stock drops down to 40, both options expire, and we keep 50 cents. If stock drops down to $10 per share, we still only make 50 cents. And again, that's sort of the 10-to-1 risk reward we talked about, because even though we know the most that we could lose on the position is, I apologize, Kurt, $4.50, the difference in the strike prices if the stock moves up minus our net credit, well, that's a 9-to-1 risk reward ratio.
Right. And if we're, we're making 50 cents when we're right and losing $4.50 when we're wrong, we've got to be right 90% of the time or better or we're going to end up on the hook. So spread trades, they do cut losers short in terms of, hey, you can't lose more than your certain dialed-in loss limit. Okay. But it fails when it comes to letting the winners run. Mike, if I'm right about the direction of the stock, do I make any more?
No.
No. If I'm right about the direction of the stock, I take 50 cents on the front end, and guess what? That's what I keep, and that's it. If I turn out to be really, really right, I don't get to participate. So I got this weird idea years ago. This was in 2002, and married puts were actually already in play. It was already known. But the way that I structured mine was completely different than what the conventional wisdom was. The result, though, of using a protective put option is that you have unlimited upside in one direction, and in the other direction, it's very limited. That by itself, just the structure there, is a structure that follows that saying, isn't it? The saying is, cut your losers short and let your winners run. Okay, so by its very structure, that's how we're starting. Okay, and so what we're going to do is go ahead and show one of our case studies. This is a couple of years ago. A nice gal named Carol came to us, and then of course we're going to also show one of Mike's recent trades that I think he did almost exactly what I'm going to show. Income method number 5 and then income method 4. You did a few other things too, Mike, I think, to bulletproof Davis budget rentals.
Oh, that's right.
But I know you did 5 and 4, right? So, okay, so this is timely. Well, anyway, Carol had shares of Visa, and she had a cost basis of $84.60. Okay, and then when we did this presentation in June 2012, and when we I won't say advised her, but when we taught her about how to do the married put play to keep her gains in there, those shares were trading at 120. Okay, now I'm going to show what we talked to Carol about, and then I'm going to show, geez, Mike, what if we got in at the 120? Okay, because that would be different. You set it up the same way, but it would be a different circumstance for you and me than it would be for Carol. Carol would be in a place where she's bulletproof already. Bulletproof meaning that she can't lose. Now, without the put option, she's got this $120 level that the stock is trading at, but her cost basis had been $84.60. So this is the game that she has to protect. She's got a gain of $35.40 that she would like to protect. Okay, and what we showed her was, when the stock was trading at 120, and it was June, the September 2012 $125 put options were trading at 1040. Okay, now I know a lot of alarms are going off in people's heads right now. They're saying, why are you buying a put option that's higher in price, in the strike price, than where the stock is? The stock is at 120. Carol had it at a basis of 84, but today, or not today, but in June, it was trading in June 2012 at 120. Why are we buying a put option that's several months away in time and that's in the money? Well, bear with me, okay? Watch this. This is something else. Her total invested amount is $95, and because it's a $125 put, she's guaranteed $125 back at least, right? So that's $30 of her $35.40 gains that she needs to protect. Let me say that again. That's $30 of that $35.40 gain that she needs to protect. Now, Mike, if Carol had simply put on a stop order with about a 4% stop, that would accomplish, we hope, the same thing, right? I mean, if you put a 4% stop on it, it's at 120, and if it goes down to, 115 and change, she gets out. But what's the problem that goes along with that stop order?
Well, if the problem is it's assumed insurance. If there's a gap and the stock gaps down to, let's say, $100, she doesn't get filled at the 4% stop order. She gets filled at whatever the market price is at the time when that stop order is crossed. So she gets filled at 100. So she doesn't lock in as much profit as she thought she would with a stop order.
Exactly. Okay. So the stop order is just kind of a market order that as soon as the price is violated, Carol gets exercised at whatever the market is willing to give. Okay, and that could be really low. It could be really bad news. But a put option gives her absolute control. She has a legal and binding contract that says that she can sell at 125 or better. She gets $125 out of this or more. Okay, so that's where she starts. So what she has that Mary put play, but there's something missing. There's no capital loss here. There's no way that she can actually lose any capital that she's invested. All right, now, I know what a lot of folks are saying. That is a lot of money to spend on the put option. Who says I want to spend $10.40, on this little insurance policy? Well, let's talk about this. Okay, first of all, the 1040 isn't really the cost of that put option. Yes, we're putting up 1040. But Mike, the stock is trading at 120, and we're buying the 125 put option. So $5 of that is really, it's on deposit.
Yeah, it's guaranteed. We're guaranteed to get that back. The worst we can do is get $125 back for the stock.
Exactly. Okay. So $5 of that put option is what we call intrinsic value. It's money we're going to get back no matter what. If the stock goes down, we get it back. If the stock goes up, we get it back. If the stock trades along sideways, we're going to get the $5 back. Okay? So $5 of that 1040 is coming back no matter what, as long as we're not asleep at the wheel 5 months or 4 months later when the put expires. Okay? All right. Now, the difference of the 1040 cost and the $5 that we're guaranteed to get back is $540. So really, when you analyze it, $540 is what we're spending on our insurance policy.
Mm-hmm.
And the insurance policy is several months out. Oh, I guess it was actually 3 months out. Okay. So what is 3 months divided by 540?
That comes out to $1.80 per month, right?
Right, exactly. $1.80 a month, $6 a day. Okay, is what I'm paying for my insurance policy to keep this stock protected at its level. Okay. All right, and now, with respect to my friends over at Monty Python, now for something completely different. We're going to take a look at a structure that we're going to introduce to this already bulletproof profit machine, okay? Remember, Carol's got shares of Visa. She's also got an insurance policy. She's in a place where if the stock goes down, she's got something that's more airtight than a stop order.
Mm-hmm.
Stock goes sideways, well, she's kind of wasting money. If the stock goes up, well, her wealth increases. So that's a happy thing. But now we're going to introduce this other structure. What is it that I'm looking at here, Mike?
This is the profit and loss chart of a ratio call spread. Right. Looks like you bought one call and you're going to sell two. Now they'll do this at a credit. So if the stock drops down, all the calls expire worthless, and you keep that small credit you originally received. That's to the left of this profit and loss chart. The peak is if the stock's trading right at the two short calls, the calls that you sold, Kurt. That's the maximum return because, yes, you may be obligated to deliver shares of stock at that price, but you're also going to get the benefit of the growth between the strike that you bought and one of the strikes that you sold. It's kind of like a bull call spread combined with an extra short call. The problem with this transaction is if you pick a stock that happens to be extremely bullish, you've got infinite risk to the upside. So small credit to the downside, decent return if it's right at the call strike price, and then infinite risk to the upside.
Right. That infinite risk to the upside. If the stock goes up, right, I'm obligated to deliver shares of stock, all right, and that normally if I did this by itself, now remember we just said that we did this, Carol did this actually within the context of owning the stock, but if she didn't, she would just be selling two calls and buying one. So that means one of those calls is naked.
Mm-hmm.
What we looked at was selling to July, not clear out to September. Remember, this was June, and we bought a September put, okay? But we're selling to July $125 calls for $3 a piece. So that's a total credit of $6. And then we're using some of that to buy a July $120 call for $550. So we have a ratio here, 1 call to 2, okay, or 2 to 1, depending on how you 2 sold, 1 bought. So that leaves one of them naked. I get 50 cents, which I get to keep no matter what. And then if the stock goes up a little bit, I might get paid again. The problem is if the stock goes way high, I get into trouble, okay? The objection is, doesn't that put even more at risk? That 50-cent credit comes with infinite liability. Why is it infinite, Mike?
Well, because that naked call has infinite risk to the upside. You don't have anything to cover the obligation. It's almost like shorting shares of stock on the position.
Right. Okay, so normally doing a ratio call spread comes with infinite liability. All right, again, the ratio call spread, you sell 2 calls, buy 1 with some of the proceeds, and you end up with a net credit. Unfortunately, there's unlimited risk normally. But Mike, what if I had the shares of stock on hand to deliver?
Well, then that would cancel the obligation of that 1 short call that's not protected.
Exactly. So with the ratio call spread, you get paid on the front end. If the stock stays down, you keep that money. If the stock goes up a little bit, let's say it was at 120, but let's say that your stock goes to 125, and you've got 2 short 125 calls. Well, what happens to those 125 calls at expiration?
Well, they expire worthless, don't they?
Yes. And as they expire worthless, my $120 call, which I've been paid to own, is worth something. It's worth $5, so we can cash it in, and that's kind of cool. Okay. Now, normally the problem that goes along with having a ratio call spread in place is that unlimited upside risk. Okay, but not if we have the stock on hand. Okay, we don't have any of that upside risk, none of it, in the context of owning the stock. Okay, when we have the stock on hand to deliver, there's no risk to our capital for doing the ratio call spread and doing it according to the rules. Mike, I suppose you could risk something if you have the stock at a higher cost basis and then sold calls at a lower cost basis. You had stock at 100 and you sold $90 calls. I think you could screw yourself that way. Okay, but if you follow the rules that we show in the blueprint, this is Carol's Visa chart. Okay, after picking up a put option to protect the downside, and then buying 1 call and selling 2 against. What's different about this this setup here?
Well, not only is you have a peak return there, sure, at the top at 125. You're still making a reasonable profit if the stock continues to move up. But now, even if the stock falls, you're still going to make a profit as well.
How about that? How about that? If the stock falls, we're profitable. If the stock goes sideways, we're even more profitable. If the stock goes up a little bit, we're even more profitable. Okay, and it does kind of flatten out at a certain point with this particular income method. There are income methods that we use that leave the upside open, but we're not going to show that today. Okay, so say you do hold the money net play until expiration. You got paid to put it on in the first place. Okay. And you have the stock on hand, so there's no risk. There's no capital risk, is there, Mike, when you add the ratio call spread?
That's right. We don't take in any margin requirement because the broker just sees it as a covered call. With a bull call debit spread, we separate that out. One of those short calls is linked to the stock, so it just becomes sort of a covered call or a collar trade with our protective put. And then we've got a bull call debit spread that we were actually received at a credit.
Exactly. Okay. So the really exciting thing is that there's a huge range that we're going to be able to capture a second credit, because when the stock closes between 120 and 130, any place between there, we can manage this for a second credit. Now, there's a lot of different ways to get a second credit out of the money net play, and they're all listed in the blueprint, okay? But today we're just going to show one because we're going to show the actual way that Carol is able to get paid twice, okay? Now remember, getting paid twice we've talked about how this ratio call spread has no upside risk to it because of the fact that there's stock on hand to deliver. So all that upside risk goes away. But how is it that we get paid twice for this play? Well, we'll go ahead and show the nuts and bolts of one of the management techniques that captures the extra premium. It's opened at a credit, and then you may be able to close it for a second credit. Okay? Now, by the way, before we show what happened with Visa, if Carol's stock goes down, she'll be happy she picked up the put, right? Would it be worth that investment? You know, she spent the $10.40, $5 of the $10.40 is guaranteed to come back, and if the stock keeps going down, 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 that put's going to go up, 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 and she'll be glad that she picked up the put, right?
Yeah, she's guaranteed that profit because she locked in at a minimum $30 of the $35.40 unrealized gain she had.
Right. Now, if the stock travels sideways and it never goes any higher than 120, well, she's just been paid 50 cents, you know, for a month. You know, it's June, and she sold the July ratio call spread, so she's going to pick up 50 cents, you know, for that month, and so that's good. And she may get paid a second time if it stays anywhere between 120 and 130. If it goes up, that money net is going to capture as much premium as she spends on the put option. If it goes up, if her stock goes up, that money net is going to capture as much premium as she spends on the put option. Okay, so let's watch this. I first showed these slides back in June 2012. Okay, now the slides that follow are what happened. Okay, the slides that follow what happened. These are closed on July 20th at $125.75. Okay, now with the short calls being in the money, Mike, what does a covered call seller got to do if they want to keep their stock and they've sold a call,
right,
and the stock is trading above that call strike price?
Well, we're going to have to pay to close that position, aren't we, Kurt? Right.
It was 75 cents in the money, but Carol can't pay just 75 cents. You know, the stock is trading at 125.75 towards the end of the business. Why can't she just pay 75 cents and call it good?
It's just because the market maker is going to want to have some premium. You're not going to be able to close it for exactly intrinsic value.
Okay, so help me out here. We own one $120 call, and we're short two $125 calls. If we buy one to close, we're going to spend 90 cents. Okay, and one of those short calls was obligating the stock to be delivered. So now we don't have that problem. Okay, we don't have that problem where the stock's going to be called away. The stock has gone up from 120 when we started this whole episode with Carol to 125, actually 125.75. But we only spent 90 cents to hold on to it. So is that a good investment, first of all, to spend 90 cents to keep a stock that's up $5 and change?
Absolutely. It's a fair trade-off. It's a good trade-off.
Absolutely. Yeah, very good trade-off. Okay, so we're spending 90 cents. Okay, now the money net is composed of one long 120 and two short 125s. We just closed one of those two shorts. So what's left?
Well, we've got one of those closed. We've still got the long 120 call and the short 125, which essentially puts us into a position of a bull call debit spread where we can close it out and get close to the 5 points back.
Exactly. Okay, this is a bull call spread. Bull call spread. Now, in case you don't know what a bull call spread is, it's where you own a long call option, right? And you've also sold a call option at a higher strike. And when this thing closes, if the stock is trading below this strike, you make nothing. Okay, if it's trading in between, you might make something. If it's trading here or higher, you make the maximum amount. In this case, $5. Okay, and in fact, Mike, this is expiration Friday, and the stock is trading at 125.75. So, are we in the money?
Yes, we're 75 cents in the money, Kurt.
Yeah. Okay. So here's what's going to happen in the middle of the night. My broker, or Carol's broker, really, looks at the $120 call and says, Carol has the privilege to buy shares of Visa at 120. I'm going to go ahead and exercise that privilege for her. And so he buys, on her behalf, shares of stock at 120. And he also looks and says, wait a minute, Carol has the obligation to deliver those shares at 125, and so that also happens. These processes are called automatic exercise and automatic assignment. Okay, you should check with your broker, make sure that you're set up for that automatic exercise, automatic assignment. It's not the same in all countries and on all exchanges, okay, and with all brokers. But check and make sure, because this is what happens here. In the middle of the night, Carol gets $500. This happens with 100 shares, okay, and she makes $500, okay? So did you get that? It took in 50 cents, Mike, at the beginning of our money net play, income method number 5. We took in 50 cents at the beginning, and we paid in 90 cents to keep our stock. By the way, the stock is up 575, so that was a good investment to spend 90 cents to keep that stock. It's up 575. Now, we get a second credit, or Carol gets a second credit of $5 for the bull call spread. So it's a bull call spread that, you know, ironically, we got paid to own. Okay, so what's coming in is $5.50, and on expiration Friday, we're spending 90 cents to keep our stock. So that's $4.60 income. Mike, is that a lot better than you could get with a covered call play?
Well, yeah. I mean, we saw it earlier. If we just sold the 125 calls, Kurt, we wouldn't have even come close to that premium.
Right. If we sold the 125 calls, we would have gotten in $3 premium and still spent 90 cents to keep our stock, so it would have been $2.10 premium. But instead of $2.10 premium, we're getting to keep $4.60. That's more than double the premium. Pretty cool, okay? And the stock, of course, is up 575, so that's not a heartbreaking thing either. Kind of cool. Okay, so this is how things were for Carol, okay? What had been the problem? The problem had been that she had an 84.60 cost basis on her stock, and the price was at 120, so she had a $35 gain to protect, but no guarantees. Okay? Well, what's the situation now? Well, remember, we bought a put option far out in time, building a fence around the stock, okay? And then we used income method number 5 to grab 50 cents now and maybe more later. In the case of Visa, in this Visa trade, it was $4.60 that we had to capture, okay? So $4.60 is what we captured. And before the protect was before the stock was unprotected and stagnant, but now this stock has a nice warm overcoat and an intriguing possibility. We might capture more than we spent to protect it. Take a look. Remember this, we have Visa shares. Carol's cost basis was $84.60. The September 2012 125 put, when the stock was at 120, then that put option was at 1040. So the total invested was 95, and guaranteed exit is 125. So Carol has protected $30 of her $35 gain. Okay, she had been in this place with a $35 gain to protect, and now it's more like, okay, she's got $4.60 in hand for doing the money net play. Didn't sell the stock. She still has that put option because the put option is further out in time, right?
That's right.
Okay, so now her worst case scenario is if Visa goes to 0, she's got $34.60 locked in, and that's very close to the gain that she had to protect. But what's really remarkable about this is she still has unlimited upside potential, and Visa is going up. So is that kind of a happy, exciting place for her to be in?
Absolutely. She has no fear of anything coming up, no fear of any earnings announcements going forward. She's locked in and guaranteed the profit that she had on the position and can still realize further upside. Exciting.
Okay, so what's different now for her? Well, she can cash in that stock at 125 no matter what happens to the downside. And remember, some of what we spent on the put option is on deposit and it's guaranteed to come back. some of it is something that we're actually paying. We actually paid $540 for this put, but then we collected $460. Okay, and the stock has grown. Okay, and this ratio call spread was played in July, but there's also August and September until the September puts go away. So she's still got the protection. It's really exciting. Okay, and besides this, there's more income methods that she could use. She doesn't necessarily have to use income method 5, depending on what her expectations are, what the market's doing, and what her conditions are. Okay, pretty cool. All right, so again, she's in a place where she can't get hurt, and she's able to do well. Now, I know that there's probably another objection out there. Mike, there are probably, on the line right now, there are probably folks that have stock that's up from where they got in and would like to maybe apply this, okay? But I think other folks might not. They might not have a stock that's already up quite a bit from where they bought in, okay? So could this still be useful? Could the structure of the married put play still be useful?
Of course, Kurt. Yeah, it can still be used.
Right. Okay, so we're going to look at the same play again from the perspective of somebody just getting in. Remember, Carol's cost basis was $84.60 or something, $84.60 on the stock. But what if we got in that day? What if, Mike, you and I consulted with Carol, and we talked to her about what she could do to bulletproof herself? But could we become bulletproof? Let's find out. Visa shares were at 120. We would not have the $84.60 cost basis. We would still pick up a put option, the same put option, at the same strike price, because this is the rules of the blueprint. Okay? And that makes our total invested amount $130.40, and then our guaranteed exit is still $125. Okay, so again, $540 is the amount that we have at risk. Now, first of all, Mike, out of the $130.40 invested, what percent is 540? Is it like, less than 5%? Would you say?
Yeah, it's about 4.3, 4.4%, I believe.
Okay, Mike, I'm going to throw up another poll here real quick. I'm just going to ask folks how happy they are with their 12-month performance. Okay, how happy are you with your 12-month performance? Are you absolutely kicking butt and taking names? Are you very, very happy? Are you, hey, I haven't lost this year yet. Okay, I'm making money, but not enough. Or do you have mixed emotions? Have your losses cut into your wins so much that it's either a net loss for the year, or it's so little of a gain you might have done better doing something else with your money? Okay, or did you lose money to the tune of, hey, this hurts? Okay, or are you ready to quit? All right, so this is a big spectrum. Instead of just yes or no, are you happy with your trading? Yes, no. No, we've got a real spectrum here. I want to see who's very, very happy. I want to see who's very unhappy, and everyone in between. So you can only pick one of these. And folks, we got 5 seconds left, and I'm going to close the poll. So 3, 2, 1. This is not surprising, but it is sad. So Mike, less than half made money last year. Okay. Our extremes are on the edges there. 6% absolutely kicking butt and taking names, and 6% that are ready to quit. I'm happy to see that there's 38% saying making money but not enough. I'd be happier if that was, a bigger number, and if there's a bigger number in the absolutely kicking butt and taking names, that would be great. But look, between the first two lines there, that's less than half of our audience. 31% mixed emotions. You're running out of gas. Your losses are greater than your wins, or perhaps your losses are cutting into your wins enough that you're saying, why am I doing this? Why shouldn't I be doing something else? Mm-hmm. 19% lost money last year, and it hurt. Okay, and some are ready to quit. So not cool. So here's what I'm going to do. Before we get into everything, let's just talk about the downsize of this one. Okay? if you limited risk, like just what we showed, and made it so that you couldn't possibly lose more than, say, 5-6% in any one trade, but you were able to take advantage of, you know, your stocks going up, would it have made a difference?
Mm.
Would it have made a difference? Would you be one of those that were very happy with their trading, one of the 6%? Would you do okay, but maybe did you do okay last year, but you'd do even better if you'd applied this? Did you lose overall last year, but perhaps there was a light that went on, and you just said, wait a second, if I'd have done that, I would have won last year? Or might you have still lost? You know, if you did indeed lose last year, if you still lost, would you lose much less? Or do you think that, hey, you know, that really just wouldn't help? I don't think keeping my risk down to 5-6% of my capital is going to really help me. Okay? All right, let's leave that pull up for another few seconds. And Mike, I think we've got it set up to where folks can vote in more than one category. So if you wanted to vote in more than one category, you can. Okay, let's leave it up there for 3, 2, 1. Let me see if I can, oh, dang it. For a second there, I thought I was going to catch it where it was all divisible by 5. Okay, Mike, let's talk about these results. What do you think of what we've heard here?
Well, we do have 8% of our audience, Kurt, saying that keeping our risk below 6% wouldn't have helped their trading. So they maybe already are doing some form of that. You know, maybe they're doing day trading where they're keeping their losses to only 1 or 2%, but they're trading quickly so that they're only gaining 1 or 2% of their closed positions as well. So they're not maybe allowing the losers to run, but they're keeping their risk limited. Now, 50% of the audience, Kurt, say they would have lost, but they would have lost much less. So, okay, they're going to be in a better position because they're still going to have more money to continue to trade. Now, 17% lost overall last year, but they would have won if they'd done that. And what do you think about that, Kurt?
Well, that's a game changer. I mean, to come from, you know, I mean, we didn't change anything about our stock picks, did we? We didn't change anything about what the market gave to us, you know, our luck or our technical trades expertise, okay? We didn't change anything about that. We only changed, hey, if you didn't lose as much, and that it was a game changer for 17%. It's also a game changer for another 17%, the folks that said I did okay last year but would have done even better. And we only had 6% say I am kicking butt and taking names, but 17% would have been saying, yeah, that's me, I'm kicking butt and taking names. So very cool, okay? So let's take this a step further, okay? This is the setup. Now, Mike, is the very same income method open to us as was open to Carol?
Absolutely. We're still going to be able to do it. We don't have the bulletproof status, but you're still going to be able to apply that adjustment.
Right. So this amount at risk of $5.40, we're going to cancel 50 cents of it by doing the income method number 5 play in the first place. Okay, we cancel 50 cents of it. Okay. And then afterwards, of course, it ended up being $4.60. Okay. So the income from doing the money net play ends up being $4.60. So our cost basis minus the income gives us a new cost basis of $125.80. Now, that's in July, and our put protects us clear out to September to the tune of $125. So, Mike, what's my risk still in this position per share?
Well, now that you've taken in the 460, you've only got about 80 cents at risk with the 125 put.
Right, and we're sitting on a stock that's up $5.75. Okay, so if it reverses and if it goes in the toilet, the most I could possibly lose is less than 1% of my investment, 80 cents per share, less than 1% of the investment. Okay, that's all we can lose. And yet, the upside is unlimited, okay? And so this is what happens. Our break-even on what we spent for both our stock and our put is represented by this dotted line. And so this bottom line here, that represents our strike price of our put. So all we can lose is the maybe 5% in here. But after doing the income method, that's even narrower, okay?
Mm-hmm.
In fact, we can do the income method to the point that that we've offset all of our risk. See, we had $5.40 risk, and we offset it with $4.60 income. What if we kept offsetting it? Let's show something even more different. This is kind of exciting. On expiration Friday, those $125 puts that we had spent $10.40 on had come down to $4.75, okay? But that's okay for two reasons. The first reason is our stock went up by $5.75, and we still own that, right?
That's right, Kurt. So it's not a one-to-one ratio. The decline we have in the put is more than countered by the gain in the stock.
Exactly. The decline in the put is more than countered by the gain in the stock. Remember, we spent $10.40 on the put. The stock is up $5.75, and that put is still worth $4.75. $5.75 plus $4.75 is $10.50. Well, okay. $10.50 is what we still have. $10.40 is what we spent. We're still ahead of the game. But watch what happens when we do this. If I take the $4.75 and I cash in my chips there, if I just sell it, and let's say I get filled at the bid, okay, I sell it for $4.75, and then I buy the next put up. That would be the 130 put for $7.55. Here's what we would spend. We sell the 125 put and buy a 130 put in its place. We're going to spend $2.75. Well, what's remarkable about this purchase? When I buy something for $2.75, I want to get something out of it. What am I getting out of this?
Well, you're getting 5 points back, Kurt. You're getting a 5-point higher guaranteed payout, but you're only paying $2.75 to do it.
Huh. Okay. So my cost basis for my Visa plus put option, my reactive profit machine, where I have Visa stock and a put option, my cost basis that was adjusted because of income method number 5, cost basis is $125.80. If I spend $275 to use income method 4, okay, what happens now is I've invested a total of spendable cash. I've invested a total of $128.55, but what does my put guarantee me?
Well, you're guaranteed to get 130. So now you have a negative at risk, Kurt, and that negative at risk means that you're bulletproof.
Bulletproof. In other words, I have negative risk. Now, at this point, do I have any short calls or anything that's going to prevent my stock from gaining more value?
No, you've already closed out the income method number 5 position for that credit, same as Carol got, very similar. And now you've got a position that has no risk to the downside and unlimited upside profit potential. Wow.
That's the deal. Okay. So that's bulletproofing, guys. What do you think of that? I'm going to go ahead and ask, first of all, what 2 takeaways did you get from today's lesson? Okay. What 2 takeaways did you get? Did you like the idea of limiting risk to single digits with something way better than a stop order? That's what we did with buying the put. Did you like seeing how the put could be moved to guarantee a higher payout? Did you like how a spread trade could take income, but because it's a shorter duration after we manage it, now we've got the top left off? You like that? Did you appreciate the fact that the structure of a trade is more important than the trade itself? You know, if you had traded the same stocks last year and traded it with the same timing, but you had structured it in such a way that your upside was left open and your downside was totally protected to, the tune of, say, 5-6% at the beginning and maybe even bulletproof later on, would you have had a better year? Almost everybody said yes. I think all but 8% said yes on that. And also, did you like bulletproofing? Okay, so let's go ahead and leave that up for another 3 seconds, 2 seconds, 1 second. Cool. First place was bulletproofing, Mike. Tie for second place. Folks appreciated income method number 5, and they also appreciated the structure of the trade. Third place, seeing how the put could be moved to guarantee a payout. Those are the guys that appreciate income method 4. And then finally, limiting risk to single digits is something way better than the stop order. Very cool. Very, very cool. Okay. Now, we're not even at the top of the hour, but I'm pretty much finished with explaining the concepts. And maybe we can take any questions. And Mike, I think you might want to share your more recent trade. This trade was from 2 years ago, after all. And I think a lot of folks would like to see a recent.
Yeah, we're not gonna have I don't have any quick slides on the historical stuff, and it's hard to show the historical stuff. So we might just look at a couple opportunities that exist on other positions, Kurt. Ron sent in.
Could we open the Fusion portfolio and look at that, or?
Yeah, I mean, we can. It's going to be hard to see what it actually did with just looking at the numbers there. Ron asked a question: what if the stock stays flat for 90 days? Will the strategy still work? Well, the blueprint in the home study kit, which describe the full techniques, teach 11 different income methods. Of the 11 different income methods, some are best used when the stock moves up, as Kurt showed today. But there are others that can be used if the stock stagnates or if the stock falls in price as well. So if it stays flat for 90 days, you will be able to make adjustments. You might not be able to bulletproof, and not every position is going to be bulletproof. But you will have opportunities to make adjustments following the rules in the blueprint. Very
cool. Other questions?
Let's see. John had mentioned earlier that he was. I apologize that he was very happy that he had the puts today. Of course, seeing how some of those things have fallen in price. John's been following along the radioactive trading techniques for a while.
Very cool. Thank you, John. Yeah, we've had a lot of times where folks have written in after a dip, after some kind of catastrophe also. For example, in the end of 2008, we got a lot of thank you letters. On the day of the flash crash, the so-called flash crash of May 6, 2010, Mike, you had positions that were bulletproof and other positions that had 1%, 2%, 3% risk still in them.
Mm-hmm.
So you weren't very rattled by that flash crash going on, were you?
No, I didn't have any concerns. I didn't need to panic adjust or try to do anything on them. I could just sit and wait it out because I knew what my risks were up front.
Right. My mother called me. I think I told you about this. My mother called me, and she was really concerned. She says, Kurt, I know you do things with the stock market. Are you okay? Something happened today. And I told her, well, Mom, I love you. I was taking a nap. Catching up a little bit, and I'd like to get back to it. And she's very sweet. Let me hang up, and go back to sleep. So that was my flash crash experience, But not everybody was bulletproof during that time. So it's kind of sobering. Okay, Mike, are you going to take the screen from me, or?
Yeah, I can do that.
Yeah. Okay.
Okay, and this will answer another question that came in, I believe. Oh, hold on. Okay, this is Avis's question. Can you show the money net part of the strategy? Okay, well, let's take a look. Kurt, this is the Fusion portfolio. That's the actual CAR trade that we're in right now. It's you see it's bulletproof there. And it could be liquidated for 7.6%. The stock has pulled back recently. I'm not forcing myself to do any adjustments right now, Kurt, because in 6 days it has earnings. So I don't want to do a capped upside right now. I'm just going to leave that open. The stock has pulled back a little bit. So this isn't, what we're making right now. This is what we're guaranteed all the way out to January expiration. And actually, this isn't the put we have anymore, but this was the original position. I bought shares of CAR at $49.45. And at the same time, bought the January 55 put at $9.50. Okay, so total invested was about $58.95, and we were guaranteed $55. So the risk was $3.95 or 6.7%. Now, as the stock moved up from our purchase price, was trading in just above 52, around $53 per share. Here's an adjustment we did with income method number 5. We were able to buy the 52.5 call at $2.60, and we sold 2 May 55 calls at $1.50. So that took in $3 total, Kurt. Let's take a look at what that looks like.
But yeah, it takes in $3 premium, but you spent $260, so it's a 40-cent net premium.
Right. There we go. And so when we look at the profit and loss chart for the position, we see here, this is, I had to use August calls, of course, Kurt, because this isn't a screenshot, it's an actual trade. But if we had stock at 49.45, bought that January 55 put for 9.50, bought one August call for 260, and sold the two August calls, the two August 55 calls at 150, we'd taken $3. So here's our 40-cent net credit,
right,
which reduced our risk from 6.7 down to 6.1%. So small net credit up front. But now we have this accelerated gain here with the money net trade, Kurt, and that's if the stock was trading at 55, well, we'd have a $2.50 gain from the 52.5 to the 55, and we still have that short 55 call as well.
So what actually happened?
At May, this was for May, not for August, but at May expiration, the stock was trading between 55.10 and 54.90, so it was just bouncing around. Well, we put in an order to close the position. I don't remember the exact prices for both ones, but we were able to buy to close our two calls, I think, for 15 cents. So we took out 30 cents, and then I believe we sold, we spent 30 cents to close the 55s, and then we were able to sell our 52.5 call for around 235.
Isn't that something? So what happened is you got paid 40 cents in the first place, put this on, and to unwrap one of the short calls, that took you 30 cents, or two of the short calls, that took you 30 cents to do. So you're ahead by 10 cents already, and then you're selling your long call for 235. So a total of 245 was captured, and if you had just done a covered call, what would it have been? It would have been...
Well, the stock was at 50. Yeah, the stock was at 53, so I wouldn't have sold the 52.5. I would have sold the 55s and just taken in $1.50.
And then you would have still had to spend 15 cents to close it. So you would have brought in 135, and instead you brought in 245. So that took your position down. Your can we scroll up and take a look at the take a look at the cost basis?
So here is the initial entry at 49.45, put at 950. Let's take out our income method number 5, and our total was 245 in, so that makes the math really simple. Our new cost basis on Avis is 47. We've got the 55 put now at 950. We haven't, that hasn't changed, still paid 950.
And so there's your new married put play where the water at the bottom is getting shallower. You used to have 6.7 at risk, now you have 2.7 at risk. You still have unlimited upside potential. And then, of course, after this, you did an income method 4 play, was it?
Yeah, we could probably synthesize that, too. So we saw the income method number 4 earlier, Kurt, with Carol, when you rolled from the 125 put to the 130. Well, let's say I hadn't done any other adjustments on Avis, and we're looking at it today. Well, I probably have the potential to maybe, if it matches the rules, but move from the 55 to the 57.5. So let's take a look. All right, January. We already have the 55 put in, $4.70 to $5. So let's just say that we're getting $4.80 for it. Yeah, let's say we sell to close. I'm sorry, at $4.80.
Oh wait, you need to,
I do that a lot.
I've done that too. You put the sell price in the quantity. Okay,
and now,
50 put for 620 maybe.
Yeah, let's call it 620, Kurt. Okay, so this
is the natural ask price, but we'd probably, with a limit order, get 10 cents off of that.
So we're paying, Kurt, another debit here. We're going to add $1.40 into this transaction, right? The 480 and the 620. That's going to be a debit of 140, but we're gaining 250. Gaining a 250 higher payout. So let's see what that would look like today. Still 7 cents at risk. Didn't quite take care of all of it. Yeah, hardly any of it, but it didn't quite take care of it all. Of course, the position we're in right now has a bulletproof status of 0.5%, and we could liquidate it for a profit right now. Kurt, there's a... Oh, I'm sorry. Do you have anything else to follow up with on that?
Well, I wanted to draw attention to that red line.
You got
because the blue line shows the position at expiration.
Mm-hmm.
The red line shows you getting out halfway between today's date and expiration. So, so if you get out sooner than expiration, you'll make more if the stock has gone up, and you'll lose less if the stock has gone down. In fact, it doesn't look like you lose anything if the stock
Yeah, you still make a reasonable profit. That's right. Mm-hmm.
Right.
And of course, we still have the opportunities to do other adjustments. On this particular position, Kurt, we are in a different setup right now. We have the guaranteed profit. We have unlimited upside potential. We actually are holding the 57.5 put. But we're not doing an adjustment right now. I'm not forcing an adjustment because I'm going to wait till after the earnings, 6 days away. I feel no pressure to do anything because I have a guaranteed profit.
Exactly. What's exciting is going into that earnings announcement, you've got no trepidation at all, but still have the you still have the excitement that goes along with anticipating a good earnings announcement. So we'll see what she does, what happens. Right now, if you liquidate, you would have, what, a 7% gain?
Yeah, almost 8% gain. Mm-hmm.
If you liquidate right now, 7% gain. If the stock plummets to the ground and dies, you still have a gain. So that's good. And the stock goes up, it's likely going to be a greater than 7% gain. So winners all the way around. Very cool. Very, very cool. Okay. Let's go ahead and take any final questions.
Yeah, I want to handle two first. One's real quick, and the other one I want to kind of extrapolate on, and also it'll tie into what you wanted to talk about too. John said, with the market in a downtrend, do you sometimes recommend just staying on the sidelines? Yeah. In my opinion, one of the worst things you can do, and what really saved me with the radioactive trading techniques, is obviously not just limiting the risk, but it's the fact that I don't feel panicked to do anything. You're in a covered call trade and your stock drops 3% today, and you figure, oh, my call's made money. It's so far the money. I bought a stock at 48. I sold the 50 call, but now the stock's dropped. I can buy my call back for 5 cents, and I need to quickly sell the 45 call because the stock's down to 44. Okay, so you generate another $1 or $2, and then what happens next, Kurt? The stock goes back up to 47, and you're looking at getting liquidated at a loss or getting assigned at a loss and locking that in. Same way with the spreads. Spread starts moving against you. You say, oh, I got to buy back these two options and quickly roll down. I'm in a bull put credit spread. The market's pulled back. I've got to close my two options at a loss and then roll down, and then it just keeps continuing down. And you're just not, you're losing more on that spread going forward. So sometimes it's really best to just be patient and just reanalyze your position. Use the portfolio tools to see if there are income methods available now that the stock has dropped, and if there are income methods available, does that match your SIGA model? A lot of times, Kurt, I see income method number 9s if I have a stock that's down, one of the adjustments that we make there, and I just decide not to do it because I apply the SIGA model, and the blueprint describes the SIGA model for each individual income method. Now, we have another question that came in from Perry, and I want to go back to my portfolio here. Did I enter this position? I hope I did. Maybe I'll go back to radioactive trading and take a look. So let's go into the portfolio tools here. And I don't know if I entered it into my test portfolio here. Okay, I didn't, but that's fine. And that's all right. Let's go back to radioactive trading, Kurt, and let's go to the open trades for the Fusion portfolio. Two different services. Radioactive trading, sort of more of a continued education to help investors who purchase the blueprint or learning the techniques. And you can follow Ernie's and Renner's trades, the president and founder of PowerOptions. You can follow along with my trades as well. But what I wanted to show, Kurt, here, let's go ahead and go into view. There we go. This is the newest married put. I want to bring this up for a particular reason. Yesterday, we entered a new trade on Hilton the other day, Hilton Worldwide, 25.23 in the 26 put. Okay, so let's clear all this out, Kurt. I want to take a look at this here.
Okay.
All right, it was 25.23. Need a period. There we go. And we bought the January 26 put at 220. Okay, now, why am I doing this? A question came in from Perry. He wanted to know, do you have any methods that generate income on a more regular basis? Your RPM is awesome, but I need income and don't have months to wait for the stocks to make the typical slow move up. Well, Kurt, you've been doing this for 12 years, 15 years, 12, 13 years now, right? When you first started the Blueprint
Yes.
about 2001, 2002. Actually, it was more like 2000, 2001, wasn't it?
Yes. I actually was putting real capital in October 2002, but before that I had been developing it with virtual trades.
Mm-hmm. Mm-hmm.
So.
But here's the question. Here's the most recent married put that we opened. It's got a 5.2% risk, Kurt, 143. Now, when I open a new married put, it's because I'm bullish on the position. I'm expecting the stock to move up, and usually I'm hoping I pick the stock that I feel has the likely, or what I feel might be the best chance to move up 5 to 8% in the next 30 days. What do we know about radioactive trading, Kurt, from your 12 years of doing it, from my 6 years of doing it, is that no matter what you think is correct, when you first see it, it's not. The first thing is, okay, you bought stock at 25, 23, you bought a 26 put. Why not just sell a 26 call right now? Well, number one, there's not a lot of premium available, right? I want more premium. I don't want to sell the 25 call, even though it has 30 cents premium. I could go to September, but let's try that, Kurt. Let's actually just go to September now. A 26 call's got a little bit more premium. Let's say we get 40 cents for it, okay? So I'm going to sell the 26 call. Let's just simulate that, and we're going to sell it for 40 cents. Now, when I found the position, and I spent
the rules of the Blueprint, but go ahead.
Yeah, it's at the right strike price, but what did I just do? By trying to force myself to generate income, I did reduce my risk. We took it from 5.2 down to 3.8%. But I put myself in a position where if the stock moves up and is trading around $26, I can only make 1.3% now. And if it moves up beyond that in the direction I thought it was going to go over the next 30 days, move up 5% or so, we expect to see maybe a $1.20, $1.30 gain on it. And if it exceeds my expectations, especially now since we're in an earnings season, Kurt, but if it exceeds the expectations, well, I've given myself 2 ways to lose. This just isn't good.
You're shooting yourself in the foot, basically.
Yeah, and when investors read through the Blueprint, they see income method number 6, they say, oh, well, that's great because you're generating premium, but you have an unlimited upside. But if you do it too soon, and if you do it at the wrong strikes, you're going to put yourself in a similar situation where you have 2 ways to lose, and in the direction that you thought the stock was going to go initially. There are neutral income methods that can be used. 8 and 7, for example. 6 can kind of be used in a neutral condition as well. But the reason why we don't say, oh, generate income, is because we have the ability to do that when the stock does what we want. We have the ability to do that if the stock doesn't do what we want. But we have to exercise patience, because if we try to force just generating premium too soon, that's going to put us in a position where we don't want to be. I mean, investing is a trade-off, Kurt. I like having my protection in place and then allowing the stock to grow. This is the strategy that's worked best for me in my 11 years of trading. I've been able to generate consistent profits in my radioactive trading portfolio, and I didn't see consistent profits when I was doing covered calls, spread trades, selling cash-secured naked puts, for example, buying straddles, buying strangles. That didn't really work out for me well either. And Kurt, you've heard me talk about calendar spreads before. At one point, over a 7-8 month period, calendar spreads were the most profitable option strategy I've ever traded in my life. 4 months after that, the same strategy using the same techniques and even in a similar market was the most losses I've ever taken in a strategy, and I essentially gave back all that I had made plus more. So it's
not fun.
That's not fun.
You would say that about radioactive trading. You would say that. Have you been consistent the whole 5 years that you've traded?
Yeah, on average, I've been able to hit my goals for my return, every year over the last 5 years.
And that's something.
5.5. No, it's almost 6 now, isn't it? It's 6 years, Kurt.
And 6 years. Now that I think about it, we first met in 2007 when I was I was a customer of PowerOptions, and I was just looking for those kinds of trades. And then you and Ernie tuned into my free webinars and decided to start trading radioactively. And so I think that was early 2008 when you started doing radioactive trades. April 2008 was my first one, the Office Max trade. How about that? Very good. Someone texted in, picking winning stocks is the key. Do you have a watch list that you follow that are winners? I will take issue with that. I will say that picking winning stocks is not the key. Limiting your losses and leaving your upside open is the key. And the reason that I'll say that is that I've proved with real money that you can be wrong most of the time and still make money.
Mm-hmm.
Let me say that again. You can be wrong most of the time and still make money. And essentially, you know, being as good as random, being as good as a monkey with a dartboard at picking stocks, you can still make money if you manage your trades properly. Okay, so is it better to pick winners more often? Yeah, it is better. I mean, if your money management strategy does well for you when you have more losers than winners and you're still making money, guess what? If you have more winners than losers, you'll make even more money. But I developed radioactive trading for those of us that don't have a crystal ball. And so far, it's served pretty well. Mike has done better than me as far as picking stocks. But Mike still doesn't win 100% of the time.
Yeah, I don't win 100% of the time. It's I think it's 68 or 70%.
Right.
Oh, and hold on one second here. View the track record. Here, the other answer that came in, Kurt, when you were talking about the stock selection and the stock process, the default search on PowerOptions and the RPM report we show here. Okay, it's 71% of the time, Kurt, right now. The default search on PowerOptions that's set up to follow the rules in the blueprint for what you look for, and also the RPM report on Fusion, every trade that I'm in right now, -1. Every trade that I'm in right now, -1, was identified using the default search in PowerOptions. So I'll just show them real quick. Capital Lincoln.
Did the default search find your
Absolutely. That's exactly right. We did it during a webinar on March 6th. We were just running a search, and I saw CAR, and that's what I got into. Manitowoc, that's one of the ones, Kurt, we were talking about this morning, the one that just dropped down today with earnings. Activision, Eris, Skyworks, which is now bulletproof as well. We just opened that one in June 12th. The only position that was not found in my account using, oh, and I'm sorry, Ernie's Core's position, VMware, PRAA. Ernie and I have to discuss with each other, Kurt, what radioactive trade we're opening when we're looking at the screen, because he wants to make sure that I wasn't interested in cores when he was opening his position at the end of May. And he wanted to make sure I wasn't interested in Facebook. So he was going to open his positions unless I had one already open. But all the positions that Kurt and I are in, I'm pretty sure all the ones he's in, Ernie and I are in, all of his positions and all my positions, with the exception of Hilton, and this ProShares short ETF, which I was doing it as an example of trading an inverse ETF with the radioactive trading techniques, were all found with the search. And all the positions I've closed this year were all found during a search. Hilton Worldwide and the ProShares short ETF were the only two that were not found using the default search on PowerOptions.
Right, and you wanted to do that to experiment, right? I mean,
yeah, this was sort of an experiment, and this one here is just I was reading good things about it, looking at good things about it, and I wanted to take a little flyer with only a 5% risk with earnings coming up, see how it would work out for Hilton.
Very cool. John that asked the question before came back and said, "That's awesome." So yeah, the default settings in PowerOptions for finding RPMs does very well. It does do very well as far as picking winners.
And just like you said, Kurt, I have been more right than wrong. As you saw, you know, I have been more right than wrong. Even if I would only been right 50% with the selections there, I'd still be profitable, or even less than 50%.
You've been fortunate, but I'll point out something, and that is, for example, your Talisman Energy trade.
Mm-hmm.
Talisman lost 50% of its value. The stock went down by 50%. But what Mike lost was 4.5% of his capital invested.
Mm-hmm.
Mike, if you had been doing all the same stock picks that year, and then you had gotten into Talisman Energy, that would have been a real hit, wouldn't it?
Absolutely. Mm-hmm.
Oh, yeah. But in fact, it was the greatest hit that you took that year, but the greatest hit that Mike took was 4.5% that whole year. You know, and so picking good stocks and just having one stock that's a runaway loser can diminish your gains in a huge way. But fortunately for Mike, Talisman Energy didn't hurt him.
Mm-hmm.
So, cool. All right. I had COG last year before having the BBM loss.
Blueprint.
Oh, Blueprint.
I think he meant BP. John meant Blueprint. Mm-hmm.
Yeah, very good. Super. Well, Mike, I think I'm going to need to sign out. I've got another appointment I need to get to.
Okay.
But I'm real pleased to see that you're doing so well with your account, that your the Fusion members are looking over your shoulder and watching you trade. Folks, if you think that it would make sense for you to keep your risk low and yet have 11 different tools to pay for your put option, I would recommend that you pick up the Blueprint. Mike is picking that screen up right now. I had just put up a poll here, Mike, saying, hey, what would you expect to pay for a seminar or for an information product that would take you through 11 of these kinds of adjustments that might indeed even pay for your put option, okay? So there's 5 different answers there, and I even honestly put, some folks might be burnt out or upset with whoever's been teaching them before. Remember, the mission of radioactive trading is to take care of those folks that have been burned, so let me go ahead and leave that up for about another 10 seconds. 5, 4, 3, 2, done. Look at this. We got it split among 3 different results here. Even split. Look at that. $500 or more, but I would consider it with a guarantee. Good, because the Blueprint and the Home Study Kit are 100% satisfaction guaranteed. 33% say I've spent over $3,000 for a less complete solution. Probably it was one of those weekend seminars where they, like me, I attended back in the 90s. I attended a seminar where I learned to trade cover calls, and another one where I learned to do credit spreads. And they cost $3,000 for a weekend, and yet didn't teach me how to limit losses. And then 33% say same as above, only $6,000. So, folks, I'm glad that you're with us. Mike has pulled up the Home Study Kit.
It's the special page, the link that was sent to them. Just go to see the special offers we're running right now for the Blueprint and the Home Study Kit. Just go to radioactivetrading.com/iridium, IRIDIUM. And so this here lists the bonuses that are available if you pick up the Home Study Kit or the Blueprint.
Super. Very cool. And Mike, we talk about bulletproofing so often. We talk about, hey, how about doing something that has 0 risk? How about doing something that has 0 risk? Well, there is risk to buying into a stock, but using the put option, you're very limited. But then after you use one or more of the income methods to pay for your put option, then you're what we call bulletproof and cannot lose, but you still have the ability to win. And so talking about bulletproofing with our techniques and our strategies, why not make the product bulletproof also? And so that's what we've done. If you feel as though the Blueprint did not fix your problem, go ahead and send it back, and we'll purchase it back. But we have very, very few returns, and the folks that do process returns, we get it to them right away, and it's very quick. Radioactive trading has been around since 2002. PowerOptions since when? The 90s, right, Mike?
97, Kurt. 1997.
Yeah, and good ratings, with Better Business Bureau and so forth. It's all about making sure that our reputation and our customer service is top notch. So Blueprint is 100% guaranteed, and boy, we'd sure like to have you have this knowledge. So, alrighty, Mike, I'm going to go ahead and sign out, and thanks so much for coming. And I guess I will see you on Tuesday next week.
Yeah, I don't think you will actually. I think I'm going to be on vacation coming up here. So you probably won't see me for next week or week and a half or so.
Very good.